we'll kick this party off. Thanks everyone for joining in. We'll let the other folks trickle in. I'm excited to have our speakers, our lead sponsors on today, Michael and Meryl, joining us on this webinar with Raj and Ramesh. Ramesh, you can turn your camera on and say hi. All right, so we, the three of us formed a group called the Passive Investor Partners, and this is how we're going to be investing in these properties from now on. So I just wanted to present to you guys the Passive Investor Partners, which is me, Kavita Barchake, we have Raj Tekchandani, and Ramesh Nachiappan. So today we are here to talk about the gallery at Katy. It's an investment opportunity in Katy, Texas, which is in the Houston MSA, for those of you not familiar with Houston. Before I move on to the details of the property and Michael takes us through the business plan and all the details, a quick disclaimer for you guys. This business plan is always for informational purposes only, and we always expect you to do your own due diligence and also know that these are predictions. We can't guarantee, there are no guarantees. I get a lot of investors asking me if these returns are guaranteed. No, we use a lot of data to come to these numbers, and they're all forward-looking statements. Like if something happens that we can't predict, you know, it happens. So just keep that in mind. Always get your own legal tax advisors to vet this and to do your own due diligence before investing into any deals. So here's what we're going to cover today. We're going to talk about give you an overview of the property and talk briefly about why we like this deal. We're going to introduce the key players on this team. And there's Michael and Meryl joining us today. Also, we're going to present the market analysis and a business plan for this property, as well as a rental and financial analysis. Ramesh will walk us through the summary of the investment, including the financials, and Raj will walk us through the next steps. We'll close the discussion with a Q&A, and feel free to ask any question. There are no stupid questions. There are no dumb questions. All questions are welcome here, and we hope to be able to answer it to your satisfaction. So a quick overview of the property. This property was built in 1983, is what we call a Class B asset. I don't know how that went to the next slide by itself. It's a Class B asset. It's an institutional asset. It has 316 units and an average of 807 square foot per unit. Also, the effective rate is sitting around 997 per month. And just to give you an idea, the market rents are closer to $1,100, almost $100 more than where the effective rent of the property, current effective rent of the property is. Another important thing to highlight here is the occupancy sitting around 94%, a very comfortable, stabilized asset. And as you can see the pictures, the asset really is in pristine condition. So I happen to actually go with the rest of the team to do the due diligence, and I'm really impressed with the condition of the property. 80s properties don't always look so great, but to our good fortune, the seller has spent almost $3.3 million in CapEx improvements on the property in the last few years. So the property really looks like brand new. All the kitchens are redone, stainless appliances, and Michael will talk a little bit more about all of those details. So just to give you a high level overview, the purchase price is $36.25 million with the estimated equity raise of $13 million. The reason it's estimated is a lot of it depends on the lender proceeds, and that kind of changes as we get along in the process. The price per unit, approximately $114 a door. And just to give you an idea, the price per unit was much higher pre-COVID, and the seller actually dropped their price per unit or price per door, their asking price, quite a bit during COVID, due to COVID. So like I mentioned, the pro forma rent per unit is sitting around $1,083, and the current asking rent is about $997. So we have a lot of improvement there in terms of rents to kind of go up on. Give you an idea of the Katy, Cinco Ranch area, great submarket to be in, highest absorption in Houston over the last 12 months. What does absorption mean? For those of you who are new to this, it's basically how quickly can you rent units for, just to make it simpler. So just to give an idea, this absorption rate is 215% higher then the second highest submarket in Houston. So it's an incredible submarket to be in. And also great occupancy growth, highest submarket occupancy growth. So we're looking at how the occupancy is growing in the last 6 and 3 months respectively. So you can see those numbers there. And not much is supply there because there's only one other 240 unit multifamily that's getting constructed. So there aren't really a lot of new construction properties around in that 3-mile radius of the property, all of which really contributes to the fact that renters who want to live in that submarket are really not going to have that many options, right? So overall expected returns, 80 to 90% over a 5-year period. And we'll again break that down by what your investment amount is, whether you're doing a debt investment or an equity investment. If you've already seen an email from one of us, you've seen that we've given a lot of different structures for you to be investing through, so you can pick what's the best option for you. 10 to 12% average annual cash flow, and 14 to 16 IRR over the 5-year period. So some highlights of where we are able to make the improvements to the property. Like I mentioned, the seller has really done a lot of the heavy lifting. They have new roofs. Every single unit has been upgraded kitchen-wise and flooring and all that stuff. So we really have to go do the little stuff, like what I call a light value add to the property. Like they've add washers and dryers to 193 units. And we already know that it can fetch us a $40 premium per unit. With COVID, private yards have become a big thing because people want their own little private space. So we have the ability to add that to some first floor units and increase the rent on those units. We also are looking at bulk Wi-Fi contracts with a company called GigaFi. So we are able to get some money back from there as well. And last but not least, some reserved parking and maybe even covered parking. So with that, I'll hand it off to Ramesh. Ramesh and Raj, would you please introduce yourselves?
Thanks, Kavita. Thank you everyone for joining the gallery at Katy, presented by Passive Investor Partners today evening. And in your busy schedule, we really appreciate you joining us as well. I am Ramesh Nachiappan, Managing Principal of GK Capital in Avon, Connecticut. I've been in the IT industry for the last 19 years. And in the last 6 years, I've kind of started passively investing in real estate and kind of found out the niche of retiring early kind of thing, and also focus on helping others, which is what this Passive Investor Partner team is completely focused on as well. To bring that same methodology to different segments of people who are busy professionals or who are having their own businesses kind of thing. Started investing in passively in 2014 and kind of achieved the financial freedom like last year. Have done like a this is my 13th deal as a co-sponsor. And I also invested passively in most of the deals. And even probably more. I have done like 5 more deals on top of this as passive investment as well. So technically, we have just done like more than 1,500 doors in Atlanta, Indiana, and Texas. More importantly, I have done like full cycles of the projects, 2 as LPs and 3 as GPs in 2017, 18, and 19. And that gives us a good confidence to go through the whole thing. And I'm in the process of creating a club, Passive Investors Millionaires Club, where we want to make sure people can increase their net worth by investing in real estate. Former Director of Risk Governance and Compliance at the Hartford. Thank you so much. I will hand over to Raj.
Thanks, Ramesh. Raj?
Good evening, everybody. My name is Raj Tekchandani, again, member of the Passive Investor Partners. Lovely to work with my partners here. This is going to be our second deal together. We've known each other for a long time. I'm actually founder and managing principal of SmartCapital based here in Boston. I have a background in business and tech. I come from data analytics background, and I spend a lot of time doing data analysis on all the properties and investments we make. I'm a general partner in over 1,000 doors across Texas, Florida, and Georgia. I'm also a board member of Pratham, if people know about it. It's a nonprofit here in the Boston area. I also run a meetup group in the Boston area called Apartment Investing and Multifamily Syndication AIMS. And and looking forward to bringing this opportunity to you. Look forward to talking to you again.
Thank you, Raj. All right, I'm going to introduce myself and hand it over to Michael to take it from here. For a lot of folks who don't know me, I'm also working with the passive investor partners. Like Raj mentioned, we did a deal, just finished a deal in Austin not too long ago. I am based in Austin and I'm a full-time syndicator now. Like Raj and Ramesh, we all share a common tech background and we've moved into real estate. Using that passive income to achieve financial freedom. I spent 20 years working for IBM and Atlassian and bring a lot of the skills I think were valuable in my tech background to real estate now. Over the last 10 years, I've grown my own real estate portfolio. I started with single family homes like a lot of you might have done and got into apartments, and now I'm doing apartments, senior living, and plan to expand my own personal portfolio much more and also bring more investments to my investors to expand and to diversify their own portfolios in real estate. I'm an LP in about 2,200 doors. I invested heavily as a passive when I first started. And then I started going into the general partner side of things. And I have about 1,200 doors in multifamily. And also recently did a senior living syndication with one of my partners. With that, I'm going to hand it off to Michael. Michael, take it away.
All right, thank you. Good evening, everybody. Appreciate everyone joining. My name is Michael Lee. I'm one of the lead sponsors on this deal. Similar to everybody else so far, my background is also in IT. And I was in IT for 20 plus years. And for 12 of those years, I owned a consulting firm before I made the jump over to real estate. Started out in single family like a lot of people do, but have been doing multifamily and commercial since. This will be the 7th multifamily property that I'm a lead sponsor on. And I also have one mid-rise development deal that I'm doing, a 300 unit deal that's actually just about 4 miles away from the gallery. So I love the Katy area, and I've got 2 significant investments in that area right now. My partner, who's not here tonight, David Davidenko, he's been a partner with me on this will be our 7th property together. We've gone a full cycle on one deal together. His background is in business. He's had multiple businesses in Russia and moved to America about 5 years ago and has been in multifamily real estate ever since. Okay, Meryl's on the line. Actually, I don't know if Meryl wants to introduce himself. But if he's not, I'll jump in. Meryl, I'll let you go ahead and talk real quick about yourself then. Hold on.
Sure. Hey guys, Meryl Calliser. I'm also lead sponsor. Very excited to be partnering with Raj, Ramesh, and Kavitha. My background, I'm an SEC lawyer. I've got an SEC firm here in Texas. We typically represent about 150 to 200 syndications a year, whether they're multifamily, RV parks, mobile homes. To date, I think we've represented over 4.2 billion and growing in acquisitions for clients. We do the real estate work and the SEC work. Like Kavita, I started out in single family I'm not just a lawyer, I also do some real estate, and we partnered with some private equity funds and bought over 9,500 properties, single family properties in Indiana, Missouri, Kansas, and Texas. Gradually moved into multifamily because I saw the clients doing so well on multifamily. And so I'm a GP on 500 plus doors. I'm a passive on about 800, not counting this. And I'm also in a very large development deal with David and Leander, Texas, just north of Austin. And that's it for me. I think Julia might be on.
Yeah, Julia, you want to jump on and speak?
Hi, yeah, I'm Julia Buchowska. I'm a full-time real estate investor right now. My background is finance. I spent a number of years working for various hedge funds in New York, investing in corporate distressed debt. and also a couple of investment banking firms, BNP Paribas and Credit Suisse, and their restructuring department and loan syndication department. And today I'm a full-time investor, invest in multifamily, and also have a small vacation rental firm, and extremely excited about this deal in Katy. Michael?
All right, thank you. All right, I want to kind of talk about some of our other partners in this deal, some of the firms. Callister and Associate, that is Merrill's firm, so we're very fortunate to have our SEC attorney also be our partner. We also have Engineer Tax Services. They are a large national firm that specializes in cost segregation. We have our CPA firm, Seville, Walker Dunlop, who's our debt broker. They're our lender, and they will work with the agencies in the end, which in this case will be Freddie. We'll talk about that later on. And J&T is our general contractor that's helped us with our due diligence in some projects and our previous projects at our other properties that we've had. There we go. Our property management company is Deferred Management. They're based out of Houston. Their headquarters is actually just about 5 minutes away from this property, and they manage 4 other properties for us up in DFW. So this will be our 5th property with them. They've got a lot of background, but they also have a background in property management, but they have a lot of background in IT, and they've integrated it in a very interesting way into their processes to make the operations much more efficient. So we're really happy with the way they've been managing our properties. All right, so some of this was already covered by Kavita, so I'll touch on some of the points. Obviously, the property is an 83 property. The exterior of the property is brick veneer and hardy siding. For those that don't know, it's a nice thing. Hardy siding maintains and it keeps this look very well. So it looks new. Yeah, you can see it in some of the pictures there. As Kavitha mentioned, the roof is new. I believe it was replaced back in this last year, pitched roof. That's a really big deal, especially on a property of this age. This is kind of around the age that you would need to replace it, and they've done it for us already. So a lot of the deferred maintenance that we might have to worry about is out there. Another reason why we like 80s and plus type properties is you have individual HVAC units, you have individual hot water units, and these are things that when you're dealing with some older properties that have boilers and chillers, they tend to have more costly fixes. So this is something that we like about having these properties here. So I'm going to jump onto the next page real quick. So here's just a few quick pictures of what's already been done. They've kind of redid the pool a bit around there. You'll see some pictures of the sports court. That used to be a tennis court. As you know, back in the a lot of the properties around the 70s and 80s, there was a lot of tennis courts built into them. Tennis is not as popular nowadays, especially in the tenant type of tenant demographics that we would have that live in apartments. So this was a nice repurposing of an area, of a large area. That's something that's a lot more useful and that's used more. And so, every time we were visiting the property, we would always see it in use. So that's really nice. You see pictures of the roofs right there. On the interiors, all the units already have had some level of upgrades done to them. Stainless steel appliances, cabinet fronts, you have the backsplashes, you have flooring done. Also, you can see there that the fitness center has been done really nicely. If you had a chance to watch any of the videos for the properties, you would see the fitness center. They have a little yoga section with video on demand, videos for aerobic activity, and they even have an indoor basketball court. So a lot of very unique amenities at this property. So as Kavitha mentioned earlier, the current owner spent $3.25 million, and it really shows at the property, mainly on the exteriors. And one of the other things I want to touch on, we mentioned about the property, Kavitha mentioned about Katy. Katy, and specifically, Katy is a great area in West Houston, but specifically Cinco Ranch, where this property is located, is one of the best areas of suburbs of Houston. As you can see there, the demographics is 95,000 income in 1 mile radius. That's extremely high, especially for apartments. So that allows us, the 1 mile radius is probably the most important number income wise, because generally that's where you'll get the majority of your tenants is from within that base. And so when that number is high there, that means that you're getting very quality tenants. And as you can see, some of the other statistics there, even when you go out a bit further, the number stays really high there. And then right next to the property is the elementary school. And these are all Katy ISDs, the top ranked independent school district in Houston. So is a very coveted area, and a lot of people that maybe they can't afford to live in the houses there will come and rent apartments so that their kids can go to these great schools. A little bit more about the area, kind of show you there, right in the middle, you can see the gallery at Katy is there. And it's just a high level to kind of touch on that this area is in West Houston, but I've lived in Houston since 1975, so I've been here 40 something years. And this area is probably the most booming area in Houston since I've been growing up. So Houston kind of has all shifted to the west, if you will. You can even see roughly at the top right there, you can see right around the energy corridor, but a little bit to the left of it, they have what's called the Texas Medical Center West, right? So Houston has the largest medical center in the entire world. And right around there, because of the massive amount of population that has grown on the west side, a lot of the larger hospital systems have built very large hospitals, as you saw on that very next screen right here. Hold on. Right there, you can see they've built very, very large campuses right around there. So they consider this kind of like another little mini medical center over here. So
I think just wanted to add something here. I know a lot of the audience, a lot of people who live outside Texas view Houston as a very oil dependent economy, and it was until probably the last 5 years. Oil has been down for a while now, but that hasn't affected the growth in Houston. There's just been a lot of population growth, like Michael mentioned, a lot of healthcare sectors and other areas, other employers coming into Houston. So it's no longer that oil dependent economy that it was.
yes, definitely. Like I said, I've lived in Houston a long time. In the 80s, we had the big oil crash in the early 80s, and that was really impactful at that time. And that was kind of a wake-up call for the entire city. I believe that the statistics showed at that time, 70% of the jobs in the city were tied to oil and gas. And right now, I believe it's around 30-something, 40% at the most in terms of the ties. And as Kavitha mentioned, we're a big hub for the medical field. The Port of Houston, I believe, is the largest port by tonnage in the US. So there's a lot of, Amazon and a lot of other manufacturing companies are building a lot of big warehouses in Houston because we're like a key place for, where you get shipped to. You can, we're close to South America, Latin America to ship things down there. So as Kavitha mentioned, our economy is much more diverse than it used to be. Back in 2015, we had a hit to the oil and gas. But if you look at the statistics in terms of the population growth and the job growth, Houston powered through that. And then of course, we had some other impacts from other events, but if you see the population and job growth continues to grow, where I think we've been #2 in the country for the last 10 years in terms of population growth.
And I think I've seen a lot of numbers show up for Texas. Actually, Houston now ranks on the top of the list as fastest growing cities in Texas.
Yeah, which is, you can think is pretty amazing considering how large we are already. So
yeah, I mean, Austin was up there, but I think Houston's kind of overtaking Austin now.
Texas in general is pretty good, so I'm glad we're part of that, right? So
yep.
Just kind of touch on, for the we talked about the property amenities, but the surrounding area, as mentioned, is a booming area. So to show that there's a lot of retail that makes it very attractive for our tenants to come and live, because they know they're close to 2 major arterial freeways, and then they can also get to a lot of attractive destinations too. Here's a little bit of zoomed in area of the property there. You can see right behind it is Memorial Park Elementary School, which is a highly rated school. And then nearby, you can see all of the different places that could be where people work, where people shop. You can see a bit further up there, you can see on the top right where it's just the Medical Center West. And then if you've ever heard of the Academy Sports and Outdoor, their corporate headquarters is right around the corner there too at the top. So it's another view of the same, show you, this is a property that's kind of, a property that's kind of, everything's already built around it. Look at how many houses are around there, how the population out there is massive. So I'll talk a bit about the business plan. So as Kavitha already mentioned, this property they've already done a lot for the property. They put a lot of money into it. So for us, we consider this as a value add, but it's going to be maybe a lighter value add in the sense that we're not going to be going in there and putting a lot of money to replace parking lots or upgrade the units fully, because the units are already partially upgraded. Kavitha mentioned the Gigafy package. It is a technology package where we bring fiber to the property, and then from there we run cables to each of the units, and we're able to do it such that the tenants, when they move in, on the day that they move in, they have internet access, which is very attractive to most tenants, because as they move around, it might take them 3 to 4 weeks to be able to even get internet access. Nowadays, when people are obviously moving, and especially with working from home, this is a very important feature for them to be able to have. And so putting something like this in will be able to generate a significant amount of income for us. Right now, the property does not have reserved parking. So we plan to implement reserved parking in some of the spots. And then we plan to have carports also. And, being in Houston, you have during the summer, the people that have the nice cars and tenants that we have in the property will be because of the quality of the area, they will have some nice cars, and they're going to want to make sure that their cars are protected from the heat and potentially anything else. So carports will be very attractive. And the nice thing about having a newer apartment complex is that we do have full washer and dryer connections in all of the units. As of right now, though, there's only about 100 of the units that actually have washer dryers that are owned by the property. They've already proved up that model that showed that they could get $40 higher in rent by having that. So for us, part of our plan is to go ahead and get washer and dryers for the rest of the units that don't have it, and then we can get some of the rent there, the bumps. So based on the exit cap that we have estimated it's going to be, we have it at 5.25 cap rates. We think all of that will generate roughly around $5.5 million in value at the time of the sale. Here's a few more things. We talked about how most of the interiors are already upgraded. You can see these are pictures already and how nice they look, but you can always take it up to another level. There are properties nearby us that already have granite countertops. These are not granite countertops. These are resurfaced laminate countertops. And Kavitha mentioned patio enclosures. You put the patio in. A lot of people, they have pets. They just want to be able to work from home and enjoy at home. And so having patio enclosures, and these are what we would call luxury upgrades that we should be able to get an additional bump in rent for. Here's our capital expenditures budget to kind of cover a bit of what we just said a while ago there. We have the luxury upgrades. The current plan is to do it across 50 units and prove out that model. And that's going to cost us about $3,500 a unit. Washer dryers for about 200 units there at $500 for a washer, $500 for a dryer, so it'll be $1,000, and the Giga5 package. We also have the water conservation in there, and that's basically, we're going to go in there and we're going to replace some of the older toilets that are maybe not as efficient. You know, some of the older toilets might take, let's say, 3 gallons of water every time you flush. In the newer technology toilets, it only takes like 0.8 gallons per flush. So you save a lot on water. And so this is something that we put in, and we think that we can save $25,000, $30,000 a year in terms of expense savings. So it pays for itself in short order. Touch on the financial analysis a bit. So this is just to show you the monthly net rental income starting from beginning of March, which was roughly when we would say the COVID pandemic hit us. And as you can see, there was some minor impact in a few of the months, but overall the property has performed really well. As you might know, there's been a lot of impact in a lot of the other asset classes, a lot of the other investment classes out there. You know, retail obviously has been hurt very badly. Hospitality, like hotels and motels, have been hurt very badly. Multifamily has fared extremely well in the course of events. And so you can see right here that this is proof positive of it. And we actually just got October financials from the seller today. So we weren't able to make it onto this chart here, but if we did have for October, the number would be 287. So it's actually been trending nicely up. To kind of show you the rent comps, we looked at some of the properties nearby that we consider competition to our property, and it shows that we're positioned in a good spot. That they are already achieving, you know, some of the higher rents that we want to be able to push the property to. So we won't be necessarily the first one in the area trying to push these rents, trying to implement upgrades that are maybe not proven out. We're just following what other people are already doing. The properties that have already done granted, what are they getting for rents, and the other properties, how are they positioning them? And we're seeing that they've already been able to achieve these higher rents than we have, and we're just going to follow that model. So we're not going to reinvent any wheels here. Talk a bit about the loan. Kavitha mentioned it. These numbers here will be finalized, obviously, once we get closer to closing. But as of right now, we estimate roughly that we'll get $26 million in loan proceeds, which currently comes out to roughly around 72% loan to value. Right now, we're getting quoted roughly around 3% interest rates. As most of you probably know, right now has been a really good time in terms of loans with interest rates been low for many years now, and don't seem like they'll be going up anytime soon. We'll be getting a 10-year loan with 5 of those years as being interest only. So that really helps with our cash flow, really helps with the return numbers for everyone. I mentioned earlier, one of our partners is Walker & Dunlop. And then in the back end, the agency that will be getting the loan through essentially is a Freddie Mac loan. One of the things that we really like about this loan, it has a very low prepayment penalty. In the commercial world, your loans, you almost kind of have to kind of guarantee, in a sense, your profits to them. So if you get out of the loan before the loan term, in this case 10 years goes up, then they certain loans, they charge you extremely high prepayment penalties. or makes it really onerous for you to kind of get out of the loans. In this case, 1% is extremely low, so it gives us a lot of flexibility. As I mentioned down at the bottom there, the exit strategy, there's many ways we can look at it. One is that, you know, after 3 years, we've gone through and we've implemented a lot of our business plans. We've proven that we've pushed the rents, we've lowered the expenses from the water, and overall we've increased the net operating income to a certain amount. And we can go back to the lender and say, you know, we would like to get, you know, to refinance so that we can pull out some of the capital that we have invested in this project. And that might be one exit strategy that we have there. And our current estimate is that if it follows along our plan, then after year 3, once we do that, we'll be able to get 60% of the capital back to the investors, which overall lowers the amount of risk, the amount of money you have in the deal, lower the amount of risk, and still able to cash flow on the deal. The other option is our plan, which is a 5-year hold. We'll touch on that in the following slides, but that's our typical plan. We underwrite off of a 5-year hold. And then the other plan could be, depending on how we want it, you know, we could end up holding it if we really like the way the property's cash flowing, or it could be, you know, because we always want to prepare for it. If we ever end up where we hit a recession and our 5-year plan takes 6 or 7 years, we have the ability to hold on to that. And that's kind of why we get a 10-year loan term, so that if we only got a 5-year or 7-year loan term, we don't want to be caught where we had to try to get a new loan or try to sell the property during the bottom of a recession. So that's why we get a loan term a little bit longer than our business plan, so that gives us flexibility. Okay. So here's a bit about the projected returns. This one is specifically for the Class B investors. This is based on if you invested $100,000, what would the overall numbers look like? And as you can see there, it'd be 85% return this is over a 5-year projection. That comes out to roughly around, you know, 16 point something percent return, average annualized return. And in terms of the cash flow is 11.5%, because that's going to be, that number is going to be a combination of the cash flow that you receive over the 5 years. And then at the time of the sale, there's going to be some appreciation capital gains that we have there. So it's going to be a combination of the cash flow and the appreciation that gives you the 85%. So the average annualized cash flow is 11.5%. And as you can see, the breakdown there of what we would expect there to be in years 1 through 5. To give you a little bit more explanation, I won't go too much into it, but you see there's an escrow return number. Right now, because of the pandemic going on, most of the lenders are requiring that we escrow 9 to 12 months of principal and interest ahead of time. They just want to make sure that the property is able to kind of cover the debt. So they kind of want to just take that money and put it in an escrow account and hold it just to make sure that you have enough money to pay them. So we're raising extra money for the purpose of putting that money in that escrow. But after a couple of years, when you've proven out that the property can cash flow, the lender will give you that money back. So that's what we're showing here, that we'll be giving some of that money back, and that'll be a return of the capital. Here's our 5-year cash flow model that basically shows everything in terms of the income coming in, the expenses. One of the things that we wanted to show, as you can see, we're projecting that in year 1, that there's no income increase at all over what the property is currently doing right now. Just 0% in growth. And even after that, you know, we won't show any growth until year 2, and even then only at 2%. And as you can already see from our rental trend earlier, the rent's already kind of trending up, but we're not banking on that. We're just estimating that right now we're going to wipe out an entire year. The property is just going to operate as it is right now. There's no increase at all, right? You can also see there roughly in the middle, we've got the return of lender escrow I mentioned earlier. That's what it is right there, where we're going to raise roughly about $1 million for the escrow, and then we're going to turn about 800 of that, and we're going to keep about 200 for some of the capital projects that we're planning to do. At the bottom left there is our exit cap, what's also called a reversion cap, and basically that's the cap rate that we use to estimate what we'll be able to sell the property for. And right now we're buying the property at a 4.9% cap, and we're right now the general market, everyone thinks that the cap rates will continue to go down, which means the prices will be higher. But we're underwriting a bit more conservative than that. We're estimating that the cap rates will eventually go back up. We'll see how it goes. If it goes up like we anticipate, then the numbers will hit where we expect. But if the numbers stay the same or go down, then the numbers will be a bit better. We always want to kind of go through and do a stress test of our numbers just to see what the worst case scenarios are. Because for us, what's most important is to conservation of the capital. I understand everyone wants to invest money because they want to make money. But first and foremost for us, it's important to make sure that our investors don't lose money. So we make sure we stress test the property and stress test the financials to make sure that we are not losing any of the money. And in this case, we've done it in 3 different ways. We said, okay, what if there's no growth in rent at all? And what if there's even a drop in rent for the first 2 years? And then we also want to see what the maximum vacancy that we could have at the property and able to make debt service, right? So that, you know, we can still service the debt and the bank doesn't come after us. So here is our first stress test. We show for years, you know, 1, we already showed that we were not going to have any growth at all. But what did we do for all 5 years? We have no growth in rental income or other income like carport and reserve parking. What do we have? No growth at all on that one. But we still have our expenses doesn't go away. Expenses are always going to be there, and they're always going to go up. Generally, 2% right there is what we modeled. So even with that model, as you can see at the bottom there, the property is still cash flowing. Obviously, this is not the ideal situation, but we're just wanting to see what would happen. Would we be able to cover the debt service, and would we even be able to make a little bit of money? In this case, it says yes. The next stress test is, you know, in this case, what if the rents actually drop 5% for 2 years in a row? And after those 2 years, years 3, 4, and 5, it stays low. It doesn't go any lower, but it doesn't go up either. And as you can see, even in that scenario, the property is still cash flowing. So that's what we like to see. And then worst case scenario here, what is the maximum vacancy that we can have where we have a break even of the property that we can at least make the debt service? And as you can see there, is in the 40+% we can be vacant there and still be able to make debt service, which is what the numbers at the bottom there. That's the debt service coverage ratio, which is the ratio of your expenses. Your income over your debt. So here's our cap rate sensitivity. As I mentioned earlier, we're modeling it at 5.25, which is an increase over what we're buying it at right now. So if we're increasing it, that's the numbers that we expect. If it goes even higher than we anticipate, then we have in our pro forma, the property still cash flows 10 to 12%. Our overall return numbers go to 65, 75%, but still very decent number, decent return. We would anticipate it going that way only if the economy gets weaker, but we think with interest rates staying low in the future and the economy getting stronger, we think that the cap rates will stay low. So that's the third scenario there. If the cap rate actually goes down from where we anticipate it to be, then the returns will come even stronger than we're modeling right now. Here's a big part of investing in real estate and particularly multifamily, which is the tax benefits. The government wants a lot of housing. Housing is always an issue. And so they incentivize people to invest in housing. So they give us a lot of tax benefits to do the investing. So this is one way to do it. We have depreciation. And right now, cost segregation, for those that don't know, is basically a typical house residential, which includes your single family and your multifamily, is you depreciate the value of the improvements for that over 27 and a half years. But the house is made up of more, it's not just a monolithic thing. It's made up of the roof that lasts us a different amount of time than the doors and the lights. So the cost segregation, all it does is goes in and it kind of breaks out the components of that, and it allows you to depreciate things quicker. And in this case, it allows you to kind of move some of those depreciation losses upfront into year one. So that's a really big benefit for those of you that can take advantage of it. And in this case, we anticipate that we'll be able to depreciate from 70 to 90% of the invested amount. So if you invest $100,000, we anticipate anywhere between $70,000 to $90,000 in depreciation losses, right? So these are paper losses. Any cash flow that we have from the property, that'll stay in your bank, but you'll have losses at the end of the year from the K1s that we'll issue to you. And at the end, obviously, after 5 years or so, when we sell the property, potentially there'll be some recapturing of it, but it'll be a very nice benefit for any of our investors that have high income to offset with these losses. So we'll talk about the fee disclosure. Asset management fee will be 2% of collected income, and that's paid out monthly. And we'll have a 1% acquisition fee. For the majority of the class memberships, we'll talk about in a bit. It basically, there's going to be a 70-30 split after the preferred returns. And in this case, everything is the investors will get. Basically, they will be made whole on their capital before we make any money on the net sales proceeds. We'll share in the cash flow, but at the time of the sale, investors will get all of their invested capital back before the split happens after that. All right, and at this point, I'll let Ramesh take over. Thanks, everyone.
Thank you, Michael.
Hey, Ramesh, I'll move the slides for you.
Okay, thank you. As Michael mentioned before, at Passive Investor Partners, we completely focus on preserving the capital and also protecting the investors from a preferred return as well, right? So we just want to make sure the investors' money, like people like us, and we're all passive investors too. So we want to have a recurring quarterly distribution coming in to manage whatever we are doing, kind of thing, like monthly expenses or anything like that, right? So we want to kind of provide that consistency to the members, the investors. And that is one of the reasons we thought through this analysis long time ago and kind of settled in different categories that we just want to implement for our investors. Based on that thing, for this property, we have like 4 class members. Class A is basically a debt. It's not an equity on the property, it's just a debt. So technically the investors, whoever is investing, like say $100,000, they will get 10%, every time until the property is sold. And also they will also get the bonus depreciation and the preferred treatment and everything else, because usually most of you might know how the structure works. It's a lien on the property goes first, then comes the capital of the investors, then comes all these debt structures. The debt structures takes precedence over the preferred returns, then comes the preferred returns, followed by the profit. So that is one of the reasons we are at Passive Investor Partners, we really like the preferred returns because it really protects the investors at a greater length than everything else, like a normal distribution. So on Class A, it's basically a debt structure alone. There is no upside potential for these class members. When the property is sold, they will get a 10%, and the minimum investment for this class is $75,000. On the Class B, as I said before, we wanted to classify different classes to, motivate the investors as well, right? So we just thought, okay, if we should give a preference a little bit more than, people investing on different categories. So we said, okay, whoever is investing like minimum $400,000, we will give them preferred 9% for the entire distribution. And as I said before, the preferred return, say, for example, even if they get like, based on Michael's financial analysis, if they get the 5% the first year, obviously, as part of this deal, we and our sponsors, we have to provide the investors as a catch up until the property is sold. Then only the profit will come back to it, right? So we definitely, now if we do 5% first year, next year we increase it, and eventually we have to catch up the 9% on the entire whole time, and then only the profit comes into play, both for the investors and then beyond that for the sponsors as well. And bonus depreciation is a key factor in all these classes. Every one of the classes will be getting that bonus depreciation. So say, for example, if you're investing $400,000, you will be getting 70 to 90% of that, which is, in this case, you're also looking at look at the equity multiple. That's right. If you're putting $100,000, you're getting $185,000, including the distributions end of the day. So you multiply that by 4 times or 5 times, depending on, and if it's like $500,000. So technically, it is like a 80.85 higher than what you invested to begin with. Yeah. And it's coming out to average like 7.08 average annual return overall. Yeah. Thanks. Can we go next? Yeah, the Class C is the same category kind of thing, like the Class B, but this is like a 8 preferred because the minimum investments is at 100,000. So between 100,000 and 399, technically will fall under this category of 8%. They will also get the bonus depreciation. Even these Class C members will also, are eligible to do the catch-up distributions as part of the preferred returns, 8%. And the equity multiple for this category is 1.82, like $100,000. You will invest in 5 years, you will get like $182,000, including the 8% preferred return and the potential profit that's projected. And you're looking at like 82% on a 5-year total return, and also like a 14.68 IRR if you look at the 5-year IRR, and also an average of 16.4%. And Class D is anything, minimum investment is still 75, but below the $100,000, like between $75,000 and $99,000, it is a preferred category of 7%. They are also eligible for the bonus depreciation for their tax savings purposes. And the equity multiple on this scenario is like 1.79. So any $100,000 $99,000 invested in this category would fetch like almost like $1.77 or $177,000, some towards that number. And the average annual cash flow is like 10%, and the IRR is like 14.13. But if you divide the 1.79 by 5 years, it kind of ranges up to 15.72% on an annual rate of return, like the ARR. And the total 5-year total return is like 78.61. So technically, there are 4 different classes. It's right, as I said before, Class A is just debt. B is preferred 9. Minimum investment is $400,000. C is minimum $100,000 with preferred 8% return. Class D is $75,000 and preferred 7% return. So this is basically to categorize all those different investors who can fall into different categories, and also protect their distributions at the preferred rate. Yeah. Thank you so much. Raj.
Thank you, Ramesh, for the explanation. As Ramesh said, we wanted to give a lot of options to our investors to decide what category suits them best for the returns that they are looking for. So we did went a little overboard on the classes, and we actually had a lot of discussion about it too. So with that, I'm going to hand it to Raj. Please take it away.
Thanks, Kavita. One size does not fit all, so we had to make different sizes. Hi, before we go into next steps, I just want to encourage everybody to type in their questions in the Q&A box. I know there's already a lot of questions coming in. We'll try to get to most of them, as much as we can. But please encourage all of you to enter your questions in the Q&A box. I see some people, typing the question in the chat box. It's hard to manage the two areas, but if we will take the Q&A box questions first. Once again, this is a 506C offering, as you might have heard, which is open to accredited investors only. Most of you know the definition, but quickly repeating the definition in these. It's accredited investors, the one that exceeds $200,000 in each of the 2 prior years, and if they're jointly filing, it should be $300,000 with a spouse, and reasonably expect to do the same for the current year. Or a big or, has a net worth of $1 million together with a spouse, excluding the value of their person's primary residence. There's also rules if you're investing as a firm, the firm has to have an asset excess of $5 million, or all the entity owners in that firm should be accredited. Next slide, please. So where are we now? As you will see, we are on a very aggressive timeline. We're coming into the closing quarters of the year. So what happens from now on after this webinar, we will open up for firm commitments. You see the link there, bit.ly/Katy-invest, bit.ly/Katy.invest, Katy/invest, or Katy-invest, sorry. You see it there. That's going to be the firm commitment form that you need to fill in. If you had filled in a soft commitment form, you still need to commit your hard commitments in this form. This will allow us to, make sure that we know what investments are coming in, and we expect this opportunity to be sold out very quickly. So please, after the end of this webinar or starting tomorrow morning, go and fill in the form if you're serious about it. You will receive your documents, the subscription documents, by Monday, which is probably Monday the 23rd, right? We should have the documents ready. And again, you will need to verify your accreditation status. So make sure that you have your CPA review your financials to give you an accredited status, or already have a certificate within the last 90 days. You can also get it done through a third-party platform, Verify Investor, that will give you a certificate. The wiring instructions will be given to you once you have signed the documents, and our partner here, Kavita Baratake, will be handling the process. It will be a first come, first serve basis. Position will be reserved for highest capital investments for those who subscribe first. So please keep those dates in mind. I think the next slide has some dates. We are today on 11/17. We are having the webinar, and we request the firm commitments to be open up. And as you can see, we have a target of completion of equity raise by 12/17, giving us exactly a month to round up our equity raise. That will lead us to a closing timeline as expected in the end of the year. So once again, please, I encourage all of you to take a look at this. This is a very aggressive raise, and if you are interested, please act on it soon.
Yeah, I just wanted to add here, the reason we are very particular about this is because we want to close by the end of the year. A lot of you folks want a depreciation for this year, like 2020. So we have to close by the end of the year, December 31st, to make that happen. And that's kind of what is driving the timeline for us. This is the entire team here. There are 9 of us on the team. So thank you guys for supporting us and being here. Michael and Davidenko are the lead sponsors, along with Meryl and Julia. And Ramesh and me and Raj are co-sponsoring this deal. We're really excited to partner with Michael and Davidenko and the rest of the team, because we've really known them for a very long time and have seen the number of full cycle deals they've done, the quality of deals they've done, and the output they produce, the investor returns they produce. So we're really excited to be partnering with them on this deal. And getting into a property which was valued much higher pre-COVID, and now getting it at this great price, we're really excited to see where we can take this property next. With that, I'm going to open it up for Q&A.
So I had a bunch of questions here that came in the Q&A box, and I will just read them, and where the rest of my partners can focus on answering them, I'll focus on the questions. Balaji asked, what is driving the significantly higher absorption rate for this property?
I'll jump in there. Basically, it's kind of part of what we already talked about, which is, population growth of the area. I mean, Katy, as I said, when I grew up here, when I was young, that frankly, I was out in the middle of nowhere, right? I mean, that was far out. But in the following decades, that's really been the area that's grown the most. I want to say the statistics say something like the area has tripled in the last 30 years or something like that, the population, and it's supposed to double again in the next 10 years or something like that. So, I mean, just very incredible numbers. And that's basically what it is. I mean, the area has had, the further out, 5-10 miles out, there's been, properties that have been built and developed, and those have been, getting absorbed up very nicely. I pay very close attention to that. As I mentioned earlier, I have my own development project that I'm building, 300 units, just about 4 miles away. And I've talked to other developers in the area. There's a property that's about 3 miles away from my development project, and they I want to say in June they had 50 leases, and in July they had 50 leases, which is absolutely incredible amount of leases to get, because generally you're looking at 20 to 30, and they got 100 across 2 months. So they were just leasing them out like crazy, and that's basically how the area has been. All the developers I've talked to, a lot of the owners I've talked to, the properties are getting leased up very quickly because there's just a lot of growth.
Yeah, and I think one more thing to add, it's not just the high absorption rate for the property, it's the entire sub-market which is seeing a higher absorption rate.
Right.
And the great school districts help too.
Yeah.
What is the impact of COVID, and what are the chances that tenants will not pay, and how do you account for that? And
yeah, that's at every property that I own. You're going to have a subsection. There's going to be some impact at the property. Your lower end properties. I've got older properties that are like 50, nearly 60 years old, built in the 60s, in not as good areas. I've got a property that's 2005 built and in a much better area, and you'll see it run across the board. Even those newer properties, I have impact. I have the 2005 built property. I have a nurse there that her hours have been cut. So she's paying later than she used to be. She's still paying. So there's going to be impact. We'll just have to, the nice thing is if you're in a nice area, you have the right tenant demographic. Generally, those tenants, they do care long-term about their credit and their financial situation and their status. And so they have a lot of incentive to pay eventually for the rent. So even if they're impacted and not able to pay now, the CDC eviction moratorium that's in place right now, it doesn't absolve them of the requirement of paying. They still have to pay. They just, they right now we can't evict them because of it, but eventually they'll have to pay. And a lot of them will want to pay because they don't want it to impact they don't want an eviction on their history, and they don't want the bad credit. So.
And there's a lot of questions about the seller, like why are they selling? How long they had held the property for? What do we know about the sellers, Michael?
Yeah, so the seller is American Landmark. You can Google them. They're huge. They're a big institution. They own about 40,000 units. And they're mainly selling because they're doing what a lot of us are doing, which is they're upgrading their property class. So they're selling a lot of their 80s properties, and they're moving into 90s and 2000 properties. So right, as I understand it right now, they're in the middle of selling, I want to say maybe 6 or 7 properties, and they're also in the middle of buying 5 properties. So so they're still active in it. They're still buying multifamily. They're just upgrading. So.
And Michael, how far is this area from the floods that happened a couple of years ago?
So this property did not flood. And the floods a couple of years ago, unfortunately, I'm too familiar with them. But everyone knows about Harvey. But we also had what was called the tax day flood, and we also had what's called the May Day flood. So that was like 2015, 2016, 2017. This property did not flood at all during any of those times. So which is nice because it allows us to be able to get a good, insurance on this one. The insurance hasn't gone up. So this property has proven itself through some very extreme events, Harvey being the most extreme event that I've been through living in Houston for 45 years. And this property survived it. So for me, if it survives Harvey, then it's in a very good spot.
Another question is, how many apartments are sized for families? I assume they want to know what's the unit mix in terms of which accommodate families.
Size for family, what is, let me see.
I think they mean by larger unit sizes, 2, 3 bedrooms. I think we mentioned how many 2s and 3s are there.
Yeah, roughly in terms of 1 bedrooms and 2 bedrooms, I think it's like 40 something to 50 something 60s. So it's a little bit more. I'm adding it up right here, 172. So I guess about 60 something units is 2 bedrooms. The large, there's actually a 3 bedroom too. So there's 24 3 bedrooms. That's 1,100 square feet. So they're definitely for the tenants that are looking for the larger ones. We do have, we have probably about, let me see, over 100 units that are 900, more than 900 square feet. So I hope that's the question that I answered. So
no, that's exactly. What is the lender's condition to release the funds in the escrow account?
So basically, they just want to show that the property is stable and is operating the way that they feel it should operate, that can cover the debt service. And so they just kind of want upfront, because obviously right now, like everybody else, no one really knows what the rest of COVID is going to be, right? Obviously, we're hearing some good news around the corner in terms of some of the vaccines that they have out there, but we don't know when's that going to come out. So they're just trying to protect themselves. They're obviously essentially 80% partners in the deal, because they give us 75 to 80% of the money to buy it, and they're just protecting themselves. And once we prove to them that our business plan is solid and that we can operate the property, and that COVID doesn't take us down any further, then they feel comfortable to give it back. In terms of specifics beyond that, I don't know. This is my first deal that I've done since COVID, so I'll have to see what the loan terms are beyond that. So,
Bob wants to know, what is the delinquency rate in terms of rental payment? I think you briefly had mentioned that in some of the charts, but
the current number, yeah, I wouldn't know that off the top of my head. I'm sure we can probably
come back to Bob on that.
Yeah, probably look at the profit and loss statement, and you guys can probably share that with them afterwards. But in terms of physical occupancy, is doing very well. I believe it's around 94-95% right now, physical occupancy. And then obviously we mentioned that there's going to be some bad debt due to COVID. It's going to be a small percentage. I believe the bad debt prior to COVID happening was sub 1% or so. And I think it might be around 2% right now. So it's doubled. So there has been some impact, but it's nothing crazy. So.
All right. Can one investor invest in more than one class?
Yes.
Yeah, you can take a mix of classes there.
Yeah, and that's a very good way to look at it too, frankly. I think one of the Ramesh was covering the Class A's and stuff earlier. One of the things I wanted to kind of point out about the Class A, and I think it might be one of the questions that I saw here in the Q&A, which is, does the Class A has preference? And I think that's a key point that maybe some people don't understand. They look at the Class A and they're like, it's 10%. That's nice, but why wouldn't I want the 16%? I think for the people that say, look, I just want consistent cash flow. I want something that's safe and in a good spot, and I still get the depreciation that goes along with it. So if you think about it, unless my math is wrong, if the Class A is $1 million, if we have $1 million in Class A out of a total $13 million raise, and Class A is only subordinate to the loan itself, and it's on top of the other 3 classes, then overall the property would have to lose $12 million in value before Class A's capital would be impacted, right? Because all the other equity would have to be lost first, because Class A is priority over the other ones. So it's just a very nice spot to be in if that's what you're looking for. You're looking for a safe 10% return. You still have the depreciation that goes along with it. You just don't get some of the upside that might come. So.
Omar wants to know, can you please explain the roles of the lead sponsors and the rest of the general partners, and who will be the operator?
Yeah, so I mean, all of us will be involved. I'm local, obviously, so I'm going to be highly involved. I visit my construction site all the time. This property is 4 miles away from it, so I'll be visiting this property very often. We all have our different roles and operations. We'll all be involved with property management, obviously with the passive investor team. They will be your point of contact in terms of investor relationships. They will be involved in reviewing the financials with us, jumping on property management calls when it's called for. So everybody has their own roles. There's going to be roles in terms of working with the vendors. So there's going to be a role working who deals with the attorney. In our case, Merrill is our attorney, so I guess he'll be dealing with himself. But who's going to be dealing with the general contractor? Who's going to be dealing with the lenders, property management, all the other stuff? So there's a lot of different roles. And fortunately, we have one of the things I want to point out is that our team, any one of us can act in any of those capacities because we have done that, you know. So for the vast majority of my deals, I act in all of those capacities, and I deal with all of those different vendors, and I deal with the lenders and getting the escrow returns and all the other stuff. So we're all very familiar with each and every one of these roles, and we can always, there's going to be overlap. You know, Kavitha is going to be doing some role, and I could be doing the same role sometimes, and we can back and forth. So, but we do have a roles defined, but it is almost a flex position if you think about it. So.
Great. Another question is, how does the GRM, that is probably gross rent multiplier, I believe, by my calculations between 10 and 11, compared to the other recent comparable transactions?
I have no idea because I don't look at it from the perspective of GRM. That's not how we kind of do our financial modeling. So I'll be very curious of that too. If one of you guys, maybe you guys know more than me, but I don't know because I don't look at it in that way. We look at it in terms of, generally in terms of cap rates, and then overall return numbers and cash flow. So.
Okay. Another question is, could you explain briefly of the ownership structure, the entities that will hold the interest in the asset after the deal is closed, Michael?
Yeah, sure. So we'll get a single purpose entity, an SPE forms. It's just an LLC, and it'll be the ones that actually holds title. And then all of the investors, you know, will be under that with the
I just
passive.
want to add something there, Michael, because our investors are going to come through our fund.
Right. Yeah, that's what I was going to touch on. So with the passive investor team, you guys will be coming under their LLC, and then that LLC will be a member of that SPE that I mentioned that holds title to that holds title to the property. So none of us will actually hold title, right? The LLC will hold title. And then the passive investor team's LLC will be one of those members there that owns that part of that 70%. There will be a 30% ownership that's owned by another LLC. That's the management LLC. And that's where all of the GPs will be under that team. So everybody on this call here, Ramesh, Raj, and Kavitha, Julia, me, and Merrill, and my partner David, and a couple of others will all be on the management side there. And that's the basic structure of it.
I think I'm just trying to get through these questions quickly. Who project manages the project and release funds from the escrow? I believe you've answered that. Do you want to repeat that, Michael, for somebody who might have missed it?
Yeah, sure. So it'll be one of our team, you know, so we have, in our case, Julia is the one that's working closely with our lender. So Julia would be the one that would be dealing with the lender in terms of making sure that we, you know, at the time of closing, really, there's going to be escrow in relation to the principal and interest that we mentioned, there potentially could be escrow. They'll send out and they'll do, we already actually had third-party appraisals. We haven't heard the results of it, but potentially they could come back and they say there's some priority repairs that they need from us. Maybe they found some trip hazards or something like that. And in those cases, they might, say, you need to escrow $40,000 to kind of go and repair these items, right? So those are also escrow items there. But the property's in great condition. We don't anticipate to have that or to have anything impacting, but those are the escrows. And in this case, Julia would be responsible for dealing with the lenders.
Moses has a question. It says, your year 2 is not a true 14% pref if you're returning 6K plus of the capital.
Yeah, well, we don't have 14% pref, right? We have pref that's anywhere between 7 and 10.
Right.
It's a 14% cash flow, and that's kind of why we broke it out, right? We wanted to be very transparent on what that cash flow is from, right? Because obviously it's very clear if you look at the numbers of suddenly year 2 suddenly jumping, we didn't suddenly do that great in year 2 from 6% up to 14%, and so we wanted to be clear on what exactly that meant, right? So. But obviously, once year 3 comes around, the numbers actually start rolling and you actually start seeing some solid double-digit cash flows at that time.
Hey, Mike, quick question there to follow up on that. Will that 6% or 6K be treated as a return of capital or a return on capital?
That will be a return of capital. That's our only anticipated return of capital unless we have a refinance after year 3. All of these other numbers are a return on capital, right? So that's why I wanted to show amount invested listed in the matrix to show that if you invested 100,000, it stays 100,000 until after the escrow return, and then it's roughly 93,000 you still have invested, and then at the end that's the amount of money that we have to return before we have any sort of 70-30 split, right? So we do have it listed there to show the amount of money you still have in the deal. But yes, to answer your question again, the escrow is a return of capital. So that lowers the amount of money you still have in the deal.
There's a question about the employers. I think this recording will be available to every person who registered. So there's, we had slides on the employer, so we can take a look at that. You can take a look at that, Will.
Yeah, a lot of major employers there because we're very close to the energy corridor and also the medical center. So like Michael pointed out, there's a lot of huge cancer center and other medical, and West Chase District is a huge employer. You can look that up if you just Google maps.google.com. So you should be able to see a lot of major employers. Also wanted to point out, actually drove through Mason Street that the property is located on. Huge amount of retail, right? Literally, you cannot cross the street. I mean, you cannot drive for a second without seeing retail. So there's a lot of, besides the major employers, there's an immense amount of retail right along the street that the property is located on.
Yeah, and I'll also point out, since you have the map up there, on the far left side there's been a huge amount of industrial warehouses getting built. There's a lot of jobs from that. I mentioned earlier in my spiel about Houston, about how we have a lot of manufacturing here and a lot of shipping here. And so this is one of the areas. They're huge. I want to say like 1.2 million square feet Amazon facility or something like that, Igloo. And one of the real Daikin air conditioning companies, they're building something out there too. So there's just a lot of stuff out there right now, and they're still building. I read the Houston Business Journal all the time, and I think they're building 2 other really large ones out there that's not on this map. So
right. I mean, just the immense amount of retail here, energy corridor here, West Chase, again, a lot of new large employers over here, very close to the Galleria, not that far. So it's really one of the biggest, like Michael mentioned, the biggest absorption rate in Houston, the submarket wise. For those of you in Houston, you probably are very familiar with the Katy area.
Another question is, difference between Class A and Class D. Well, Class A is debt only, even though the minimum for both are 75,000. Maybe that's where the confusion was. Class D is just minimum of 75,000, but it has a pref of 7%. Class A has a pref of 10%, but no upside. Hopefully that answers that. Is there a liquidation preference for Class A over Class B, C, and D members, Michael?
There is, right, as we mentioned, the Class A is only subordinate to the debt itself, to the lender. So during the liquidation event, and this is something that you'll see if you subscribe, part of the subscription documents will be the company agreement. And the company agreement spells very clearly what happens with the cash flow distribution and what happens at the time of sale, how the money is distributed. And in this case, after the lender is paid off all the other fees that we have in relation to the sale, well, obviously we have a broker and all the other stuff, what happens with the money after that? And what would happen would be that the capital has to be returned for the Class A first. And then at that point, then it waterfalls down to the other three classes. And the other three classes are what's called pari passu, which is on equal footing, meaning that they are on equal footing for all of the remaining money beyond their preference differences of 7 to 9%. But in terms of the 70-30 split, they all get split whatever their pro rata percentage of ownership is.
And Kavita, maybe you want to answer this one. Can the funding of 75,000 come from multiple sources, say 2 SDIRAs and 1 regular bank account?
Yeah, I did type it in the chat box. Yes, it can. But let's say we have to deal with like 3 investors at that point. It's no different for us than 3 investors. So we do prefer that we don't have to deal with 3 investors for every investor that comes in, just increases our paperwork. But we can work depending on how this goes. We can work on it on a case-by-case basis.
All right, and for some reason, my chat window now doesn't move over my Q&A box, so I can't see the Q&A box. Kavita, can you take the Q&A box from here?
Sure. This is an interesting question. What is the transparency available, especially for investor sponsor split? Is there a servicing company?
Do you understand that question? Maybe.
Yeah, kind of. So the transparency we provide is based on, there's no servicing company, Anand. This is not like a single family home where you have a servicing company that is in the middle. We basically have bookkeepers and we have accountants that actually do all the numbers, all the accounting for us. So you will have full transparency when we sell the property on the splits. So yeah, that's that.
Maybe this is not the right answer, but we have monthly reports, obviously, that also has all the financials and stuff like that. So you'll see the full financials of the property too. So it's not like, oh, by the way, we didn't have enough money for cash flow. You'll be able to see why or why not, or if we do, right? So
I think that's a great point. Yeah, you will get the entire monthly financials every month, along with the investor update reports. So you'll have full transparency from day one.
All right, my window is back. So the question is, how soon would you want the funds? Was it 1 month and a hard commitment ASAP? The answer is yes and yes.
No, we need the funds before the month. Sorry to contradict you, Raj. Preferably in the next few weeks. So the thing is, a month is like our final deadline to get every dollar in. So we don't want everybody to be wiring on the last day because it creates a nightmare for us. So,
and again, it's a first come, first serve basis. So,
Correct.
if you close the funding before that, then
yeah. So in our last deal, what happened is we hit that much sooner. So we gave a 10-day deadline, just to let you know, and we closed down everything in 10 days. We said, okay, whoever gets in and submitted the firm commitment and finished the subscription documents and get all the paperwork in place and ready to fund, we'll take them in. Otherwise, we move on. So I anticipate that will look the same because we have way more people attending this webinar and who are committing to this deal already than we have room for. So I would say first come, first serve. Please don't wait till the last week to wire your funds.
Yeah, the subscription document only kind of holds your spot, but it's not a true finalized subscription until you get that money wired in, right?
Yep.
That is correct.
Money talks, man.
That's right.
Question is there any scope for additional capital calls for any reason?
Is there any what for additional capital?
Is there any scope?
Any scope? In terms of how it's handled, I mean, obviously, we have our business plan and we don't anticipate and we don't hope there to be a capital call. But in terms of if there happens to be a capital call, how it's handled, that will be specified. It's clear out in the company agreement. I don't recall how this specific company agreement is written, and maybe Meryl, if you're on, you can jump in and talk. But generally, how it will work is that there's opportunity for someone to just maybe provide a loan. So the manager, sometimes if it's something that's temporary, the managers can provide a loan, and the company agreement will specify, you know, what the interest rate that loan will be at. And if it's a true capital call where we're asking for additional equity, generally the way it's done is that you don't have to participate, but the investors that don't participate in the capital call will have their shares diluted to whatever the pro rata percentage of whatever additional money we raise, right? So, you know, we've never had to do that. We hope we don't ever have to do it, but we do have it spelled out in the company agreement of what that might cover. So.
I want to take this question because it's interesting and it's in the chat box. Does Class A get paid 10% annual yield regardless of property performance? Do they still get a Schedule K1?
You said you wanted to answer that, or you want me to answer that?
No, feel free to answer it, please.
Oh, yeah. So I mean, just like all of the other, basically all of the classes, they have the pref, and if the amount is not met from the operating cash flow, that number is accrued until the following year. I don't foresee the Class A being that they are in the #1 spot for the cash flow, and being that we don't anticipate there being them being a huge percentage of the overall raise, that the amount of cash flow that the property pays out would not be enough to pay them the 10% pref. If that was the case, then we're already in pretty big trouble otherwise, right? So I would say, but in the situation where any of the classes we don't have enough cash flow, like in our model in year 1 and in year 2, as we're turning around the property, the cash flow that we anticipate won't be fully enough to pay out the pref 100%, pay out part of the pref. Whatever is the difference gets carried over to the next year and aggregated. So even if we don't do that 10%, let's say we only do 5%, then the next 5% is paid off the next year. And if that doesn't, then it gets pulled over then until it does, until eventually at the end, it will be paid out of it. So, and remember that gets paid before anything else in terms of what the sponsor splits would be.
Vineet wants to know what has been your performance on previous offers versus projections, Michael?
So for the most part, we've done great. Obviously, I've only done full cycle on one, so I can speak on that one in particular. That one we were anticipating, you know, as all of our deals we have as a 5-year hold is how we projected. At that time, the property did very well after just 1 year. And at that time, we had thought that maybe that the cap rates would start going up and would start impacting what the value of the property was. And so after 1 year, we were already performing at roughly year 3 numbers in terms of income. And so we took that opportunity to sell after a year, and we were in 1 year, we made a return of 42% for our investors. So that was very nice. But to tell you the truth, I kind of regret selling it because that property continued to do very well afterwards. And I wish I would have held on to it. You know, you don't ever want to cry over making money, but we did very well on that deal. And our investors were happy, and we had a lot of investors that continue to invest with us in our following deals. So yeah, so that was the return for the one full cycle I did.
Raj, before you ask the next question, you know, to Catherine's question before, for Class A, they will still get the Schedule K1. Yes.
Yes.
Here's a quick question. Sorry, Raj. Quick question. Loan to equity is 72 to 73%, right, Michael? Just clarifying.
That's what we currently have it modeled as. It could potentially get better. It could potentially get worse. Obviously, as I showed you earlier, our trending in terms of our net rental income is right now is trending positively. You know, so potentially right now we've modeled it as a $13 million raise. Potentially the lender could come back and say, hey, your property's performing well, and maybe it'd only be a $12 million raise. Potentially COVID could take a downturn and drops a bit, and maybe now we have to do a $14 million raise. So that's kind of why we chose something at 13 that we felt was relatively safe.
Yeah, I think there's so many factors right now. We thought elections would be a factor, but I think at least that one is settled.
Right. So
Yeah,
far,
Omar wants to know what are the estimated reserves that will be maintained for the deal.
So, you know, we have in terms of, at the beginning, we always raise additional money for working capital. So we generally have about 2 months worth of working capital. So there's that. We also, on an ongoing basis, for replacement reserves, which is kind of replacing all your capital expenditures, like say you have your AC condenser unit goes out or whatever it is. So we have $250 per unit per year. So that comes out to roughly $80,000 a year for replacement reserves. Obviously, you're not going to be replacing your AC every year or your roof every year or something like that. And so that kind of aggregates up, and whenever you have a large event, then you have that money that you use to pay for that.
How can we arrange a site visit? It's a question by somebody here, Anak.
Well, right now, we won't be able to do a site visit because we don't own the property yet. Obviously, at the time that we actually buy and close on the property, we'll probably have an event at the property for investors to come and see the property and tour it. As of right now, we're in our due diligence period, but that due diligence period is obviously just for the current operating team and the vendors that we have on site, and they're really strict about that, obviously, because that's a business that they're running right now, and obviously now you add COVID on top of that, there's impact too. So as of right now, there'd be no way for a passive investor to come. Obviously, Kavitha visited with us when we toured the property and stuff. So, but if at the time we will close, we'll probably have an event, hopefully sometimes early next year, depending on how the pandemic treats all of us, right? So.
Hey, Michael, quick question there. Do you think they can just drive by the property?
Oh yeah, definitely. Or yeah, obviously.
You can always drive by the property, check out the general area, you know, as long as you don't, you know, have a drove of investors walking into the leasing office. I think.
Yeah. Don't walk in there and say, "Hey, I'm with Michael Lee. He told me I can go and tour the property." So.
No, that's a no-no.
Yeah.
Balaji wants to know how much are the GPs co-sponsor investing and how much in this deal?
I think overall we're at nearly 800,000. I think 775 is what we have as a team in the deal.
So yes, Balaji, yes, we are investing, and you still heard the amount.
Yeah, at least the minimum, right? To get each, yeah.
Somebody who says anonymous, asking, investor money can potentially be locked for up to 10 years as worst case scenario. Is that right?
That is correct. Yeah. And that'll be something that you'll see in any of these private placements too. And you'll see in ours, and there'll be a lot of, Merrill, our attorney, it's his job to scare you away from the deal, almost to say, look, this is an investment. There's no guarantees, and it's not it's an illiquid investment. It's not equities. This is not Tesla stock. You can't sell it quickly and stuff like that. So yeah, you have to be prepared and knowledgeable to make sure that you're comfortable. You read through our documents, you understand how to read the financials, you have to understand how to look at this as an investment and be comfortable that potentially it could, we have it as a 5-year projection, but it could be 7, it could be faster, but it could be the full length of the loan term.
I don't know. The question says, what will be the IRR drop to if we hold for 10 years? Have you done that model, Michael?
I have not done that model, but obviously it will drop because years 6 through 10, it'll be a 2% rent growth, 2% other income growth, and the 2%. Yeah. So overall, I mean, it'll be at that point, it'll be stabilized. And, there won't be a huge jump in income. There potentially always could be, appreciation because the property is a nice property in a nice area, but that's something that we don't model right now, right? So.
And I just realized we have gone on for 1 hour and 40 minutes. So I'll take 2 more questions. What is the appreciation rate since the property was last purchased by the current owner and the most recent sale price?
Yeah, so that's kind of as Kavitha mentioned, the whole pre-COVID, this property, between what they paid for it and between the amount of money that they put into it, roughly, they're just breaking even, they're selling it for a multitude of reasons, and obviously they're not happy selling it of where they're selling it right now, but they're getting pressured by their capital investors, their equity to sell because their equity wants to exit and go to these newer properties. And then the other side of it is, frankly, if this was a year ago, I don't think we would be able to buy this property because right now, a lot of the institutional players between COVID, between the oil and gas in Houston, a lot of the big players that usually buy these type of properties are kind of sitting on the sidelines and just waiting to see what happens. And so that's provided us a very nice opportunity to come in and buy this property at a nice basis. This property, when it first came on the market back in, I want to say maybe it was April or May or something like that, when I first started hearing about it. It was going for, I want to say 123 a door or something like that was the whisper, and we're getting it for 114. So we're getting it at a nice discount because probably a lot of the potential institutional buyers that they were looking to sell for at that time kind of taking a step back. So.
And with that, we'll take one last question, which says, when do you start the payout? Sorry if I missed this part, was mentioned earlier.
No, we didn't mention that yet. Generally, we just say after about 2 quarters is our expected. It could be faster. We just don't want to promise it. So we'll just say after 6 months. That gives us time to come in, get our arms around the property, and start implementing some of the plans that we have. And it could be that we go in there and things are just rolling along smoothly. I've had it before where I say 6 months and after 3 months, we're already doing distributions. But just right now we're saying 6 months.
Great.
And the distributions will be quarterly after that, right? Michael, just clarifying because there was a question about that.
Our documents actually say right now monthly.
Okay.
Yeah. So, yeah.
Generally, we are done quarterly, but monthly is great.
For most of my deals, we've done quarterly. We started moving towards monthly because, hey, we like cash flow too, right? So we like to get our money monthly. We're part of it. We're passive investors in our own deals, and so we'd like to get the money also. So
we like monthly. We love monthly. It just increases the work a little bit in terms of distributions.
Yes,
everybody loves it. So.
Well, with that, I think we have come to the end of the presentation and the Q&A. The link that is on the screen